Thank you, Nick, and welcome everybody. Excited to have a conversation today with everybody on the line, and I'm joined by Matt McPhail, our Chief Investment Officer, and Dave Batchelder, one of our senior investment gurus here at the firm, both chartered financial analysts. I'm a certified financial planner, and I'm really excited to talk to these two guys about the markets, what happened last year, what potentially could be happening moving forward. And then we're going to talk a little bit about some financial planning topics. So Matt, without further ado, I'd love to get started. I think one of the questions we get from so many plan participants or financial planning clients is just what happened last year. Maybe we don't want to relive it from our day-to-day lives, but from a market perspective, would love to hear your thoughts on what went on in the markets, and then we'll go on to what potentially could happen in 2022. So I'm sharing a screen, and Matt, I'll turn it over to you.
Great, thanks, Ross, and good afternoon, everybody. We'll spend just a couple minutes on how the markets wound up in 2021, and then we'll spend most of the time today, I think, on questions and more pressing issues for this year. A lot of our clients on the call are probably familiar with this one-pager we typically use in our 401k review meetings, but for those of you that aren't familiar, what we're looking at here is simply a summary from last year. In the bottom section, we're looking at the major market averages sorted from top to bottom by the year-to-date returns, or that first column, and then we'll talk a little bit about the fund categories, the mutual fund world, in a moment, which is also sorted from top to bottom in terms of best performer to worst performer. So, quickly in 2021, despite the volatility and the fact that it's never a smooth ride, the markets had a great year. When you look at the S&P 500, 28.71% total return for the calendar year was excellent, another double-digit return year. And when you zoom out a little and look at the three-year column on the right, that's the average annualized return for the S&P, 26% per year for the last 3 years. So a cumulative return from start to finish over the last 3 years of over 100%. We're just at 100%. If you look at the NASDAQ, 2 lines down, 33% per year annualized, well over 100% return. So needless to say, it's been an excellent 3-year stretch here for equity markets. But getting back to 2021, just looking at the rankings after the S&P, the commodity index came in second in terms of these rankings, 27% return. And certainly a topic we're going to address today a few times, I'm sure, is inflation. And the broad commodity complex did very well last year because of all the inflation concerns out there. The NASDAQ was next, the Dow. Those are the big three equity indexes you're familiar with. The Russell 2000 is an index of small cap stocks, a solid return, 14%, but as you can see, only half the return of the S&P 500 or those largest 500 companies. So quite a difference between large caps and small caps last year. The MSCI ACWI index is an index of foreign companies, so non-US markets. Again, a positive return, but as has been the case for the last few years, foreign markets dramatically underperforming US stocks. So for those diversified portfolios that have foreign exposure, again, you got some gains last year, but in perfect hindsight, having a completely US-based equity portfolio would have been optimal. And then finally, at the bottom of the page here is the Bloomberg Aggregate Bond Index. You can see it's a negative 1.5% return. And this is the index of bond performance. Last year, we saw the start of interest rates going higher. That's a big negative in the bond market. And that was reflected in not only bond prices, but certainly bond mutual funds as well. So the quick summary in terms of the global markets last year were excellent years for stocks and for commodities, assets that typically do well in a rising rate or inflationary environment. But last year, again, was a year to forget for bond investors with some flat to small losses depending on the subsector in the fixed income market. If we look at the top of this chart where we're looking strictly at the mutual fund categories, we can see the real estate category was the top performer. And these are all Morningstar peer groups, I should mention. So these are representative of the average fund in the Morningstar peer group. Real estate up 38.5% on average. And real estate, again, in a world last year where the focus was on inflation, Real estate did very well, and no big surprise that that was the top performer. And then as we go down the line, basically without going line by line, the trends again were U.S. stocks doing better than foreign stocks. But within the U.S. markets, it was the value categories that came back to life as there was some optimism over the economy reopening, success with the vaccine, et cetera. So the cyclical components of the value space, financials, energy, those sectors did very well and actually outperformed growth last year, even though growth had very respectable returns. But this was the one change last year versus the prior years where value came to life and again outperformed growth. And then finally, at the bottom of this top section are a lot of the bond categories where, again, we've got a few negative numbers in terms of the core bond space. But if you were in high yield bonds or multi-sector, some of these more flexible bond strategies, you were able to eke out some small returns. But again, the quick summary is last year was an equity dominant year in terms of performance. And certainly, again, not to belabor the point, but over the last 3 and 5 year period, we're coming out of some very strong performance years for the stock market. So let me wrap it right there for you, Ross.
Thanks, Matt. I think that's a great overview of 2021. Certainly, we'll take some of those gains when we get them. My question to you, Dave, turning it over to you. We just talked about 2021. What does 2022 have in store?
Yeah, start with the easy ones. Thanks, Ross. So, to look where we're going, I think it's feasible to look at or understand where we've been. So let's take a step back and understand how we got to where we are in 2022. And first of all, as Matt was talking about, the incredibly strong recovery in the markets, really ever since the great financial crisis in 2008, has really been fueled by low interest rates, trillions of money printing, and an accommodative, easy Federal Reserve. So recent rumblings are that this may change this year in terms of the Fed Reserve stance. I've come to realize it's not what they say, but what they do when it comes to Fed speak. So these loose monetary policies have led to record asset prices, as evidenced by the returns Matt was going over. Just to give you an example, the reason before the recent, tech pullback per se, our growth stock pullback, Apple hit a valuation of $3 trillion. That's with a T. And then, and looking in backwards in 2019, at the end of 2019, it was valued at 1.3 trillion. That double increase in market cap is incredible by any valuation measures. Not sure how to equate it, but it's just a point in time summary. But, to summarize the point about headwinds and keeping this to the markets, we see moderate yet higher interest rates. We're already seeing those. Potentially persistent inflation, and also higher high asset prices are, I think are a true headwind for long term. Well, let's say at least short term, with the Fed turning from an accommodative policy to potentially a hawk policy. I'm not sure they can really do it. Pull it off, but I guess we'll see. I'll leave it there, Ross.
Thanks, Dave.
Yep.
Certainly some headwinds for 2022 for all investors across the country and globe. Matt, the Federal Reserve's thinking about raising interest rates. I'm curious what your thoughts are on what that will do and how it could potentially affect markets.
Yeah, absolutely. That's the big story right now, and the real dominant narrative. I think as we've started the new year, we've had some small pullbacks so far in the equity markets. No surprise after such a great year, but why is that happening? I think there's a lot of concern and apprehension over the Fed. What is known at the moment is we do have an inflation issue going on in the country. And inflation's a broad measure. You can define it different ways, but I think we can all agree the cost of living has gone up, and depending on where you look, it's gone up substantially. So the Fed is going to start raising interest rates. That's what's known right now. What isn't known, and I think this is where the issue for the market comes into, is number one, when does the Fed start raising rates? I think there's a strong feeling that it's going to happen here in March at the next Fed meeting. But more importantly, how many rate hikes will we see in 2021? Because that's going to have a big impact ultimately on a lot of things, but especially on equity performance. So if you just go back even a month or two, I think the thought was, well, the Fed is going to have to start raising rates in 2022. They'll probably do 1 or 2 rate hikes, see how it works out, and go from there. Now the narrative in the last month has really shifted toward, we've got to get much tougher on inflation. And now the market, I think, is expecting 3 to 4 rate hikes, which very well may happen. That being said, the Fed has a history and a long history of kind of overpromising and under-delivering in terms of rate hikes, which has ultimately been beneficial for the stock market. So the more that the inflation narrative builds, the more that the feeling that the Fed is going to get tougher builds, the more you're going to see price action like we're seeing today in the stock market, where there is an expectation that these higher interest rates will be harmful to equities, especially growth equities, which have done so well in recent years. So that's what's going on right now in terms of the fear of the Fed. But ultimately, again, the question is, how many hikes do we get, and where is that point where the Fed is trying to thread the needle? They want to address inflation, start raising rates. At the same time, they're, believe me, very cognizant that they don't want to spook the markets to the point where the markets have a 20 to 25% decline, which is very possible based on these valuation levels, and possible based on the Fed over tightening, if you will. So, it's really hard to see what's going to happen. Then the final thing I'll mention is, as far as the Fed goes, is we're all going to be, hearing much more about this as the year goes on, but there's some pretty important midterm elections coming up later this year. So I think the Fed is very cognizant that they don't want to be the story in 2022 during an election year. So they're really, between a rock and a hard place in terms of, on the one hand, needing to fight inflation, on the other hand, not wanting to dramatically disrupt the equity markets. So the true test, I think, will be after they've raised rates 1 or 2 times. Do they step back and say, okay, this is working and we get some better inflation numbers? Or do they have to keep forging ahead with that 3rd rate hike, 4th rate hike, which would be detrimental to the market? So keep an eye on that. But right now, it's that number of rate hikes, which is the question, not the fact that they are going to raise rates, because they are. It's coming probably in March. And again, quarter point at a time, very tiny, well telegraphed to the market. That being said, that's certainly a change in market environment versus what we've seen in the last few years, where the Fed has really been on the sidelines and letting rates stay at 0 for a prolonged period of time.
Yeah, so I think we're just going to have to wait and see, and we'll probably find out sooner rather than later. So, Dave, Matt mentioned a little bit about it, but inflation. I mean, every time I try to buy diapers, or I go out to a dinner or something with my family, it seems like things are more expensive. So, thoughts on inflation?
Yeah, I mean, from my perspective, I always tend to go back to a famed economist, Milton Friedman's take on inflation, which he said is, inflation is always and everywhere a monetary phenomenon. So, in let's bring it down to English, right? So, meaning the absolute value or purchasing power of our currency will eventually decline and lead to price inflation, which we're seeing when we have excess money printing and easy money policies, which is part of the Fed's mandate. However, when it talks about inflation, I have trouble with using just one number, because I really think inflation's individualistic. It all depends on where you live, what you consume, and potentially the way you are invested in your portfolio For example, if you live in the country, your costs are going to be much different than if you live in the city. If you have to buy, as Ross said, buy diapers, it might be different than somebody who doesn't. So that's why I think the definition of inflation is really personal when it comes to what it means to you. When looking at it from a market perspective and the global perspective, or even let's bring it down to the U.S., believe inflation will be persistent for a while, as there's so many inputs that go into prices. If I was going to watch one indicator that's easy to follow for investors, I would keep an eye on the price of oil. If oil continues to climb, it's an inflationary headwind. Oil prices over 1 year have moved 60% from $50 a barrel to $80. And right now, I think it stands around 85. So but still, if you go back to Friedman, money printing and debt issuance are the main drivers of inflation in a global economy that's interconnected. As it erodes the purchasing power of, our dollar, and also depending on where you are in the world, your currency and your purchasing power. So yeah, it's individualistic, Ross, but we all face, similar costs when it comes to grocery store and the pump.
Yeah. Yeah. And I think that goes back into why people might want to think about updating their financial plans based off of their individual goals, where they live. How's inflation going to impact your personal situation? Matt, I'll go back to you, and nobody has their crystal ball. We can't predict what's going to happen today, tomorrow, or a year from now in the markets, but you can have some ideas. You and Matt oversee the billions of dollars that Sentinel is the advisor to. I'm curious what your thoughts are for things that could do well. We're talking about a lot of headwinds right now, but is there any light at the end of the tunnel? So what's poised to do well in the markets, and what areas are you overweighting or underweighting in your portfolios?
Yeah, great question. And we looked at those returns earlier, and it's not hard to feel like everything has gone up in value in the last few years. Everything is done well in price, and there's not a lot. Quite honestly, there's not a lot of bargains, if you will, around. But in terms of portfolio construction. And full disclosure, our style is not to make big bets. We make small tilts based on where we have higher conviction. So where would we be making small tilts today? I would highlight a couple of areas. Number one, just in terms of a style perspective, we would be more comfortable with a bit of a tilt. Again, we know individuals have different goals, needs, but just from a broader generic sense, more comfortable with a tilt toward value. The value strategy, again, while it had a good year in 2021, has severely lagged growth over the trailing 3 and 5 year periods. And so we think there's some more potential for catch up there. And it's those value managers that are traveling in the sectors like David just mentioned, with energy doing very well, financials, commodities. So should we continue to see rising inflation numbers, higher interest rates, the managers that travel in the value space ought to have some better opportunities than they have had in the last 5 years. Another area to keep an eye on, and it's been frustrating, but the foreign markets have much better valuations than the U.S. market based on this recent outperformance. And we're currently in one of the longest stretches of time of foreign market underperformance versus the U.S. If you look at a long-term chart, you'll see different periods of alternating performance leadership. Foreign markets tend to do well for several years, 3 to 5 years, and then it flips to the U.S. and then it flips back. We've been in a very long period of time, mostly due to the Federal Reserve and how aggressive we've been here in the U.S. in terms of stimulus of U.S. outperformance. That is going to come to an end at some point. And so I guess the point being is, for those diversified investors out there who've had money invested in overseas stocks, we wouldn't give up on them yet. And we'd certainly think about making sure you have quality active managers in the foreign markets versus an index fund. We think active managers will have a better time beating their individual foreign benchmarks than U.S. managers will have in beating domestic benchmarks. So value strategy generically, foreign stocks don't give up on. And then there's other smaller, niche areas that I think, are attractive. We hold a little bit of gold, for example, for our wealth management clients that did well in 2020, mostly at the outbreak of COVID, not so well in 2021, despite all of the inflationary news. And it's kind of a head scratcher that it hasn't performed well. But again, as far as a diversified portfolio goes, something that hasn't performed super strong recently, something that's lagged, I think it's an interesting place to look. As far as what we would avoid, again, I think you kind of do the opposite and you say, well, what's done really well, where it might not be an avoid, but it might just make sure you're not too overweight. And so if you're in a 401k plan, for example, and you've had money in growth funds, you've probably done extremely well. So making sure you're balanced correctly, maybe you're trimming some of those profits back here at the start of the year, and making sure you're not overweight into the growth area, simply because growth is very vulnerable to higher interest rates. And nobody knows how high interest rates are going to go, but certainly those are longer duration assets, more vulnerable to rising interest rates, those growth companies, specifically technology companies. So we would just make sure that your winners are trimmed back or at an appropriate level in your overall portfolio, not necessarily sell completely or avoid, but just make sure you're not overweight into some of these areas that have, again, done extremely well in the last few years, which may continue to do well, but it's hard to say that pace of gains is going to continue.
Yeah, thanks, Matt. I think you mentioned two things: rebalancing your portfolio, bringing it back into its original composition, because you might have some drift there. That's going to be really important. But the other thing you mentioned, it goes into my next question here, Dave, for you, is a lot of news. There's a lot of noise out there. Should I make changes to my portfolio based off what I'm seeing in the news?
This isn't really a simple question. I think one of the things to keep in mind when you watch the Bloombergs and the CNBCs of the world is that nearly all the people on these channels are selling something or talking their book of business. Okay, so they all have a different angle, probably have their own bias on how they're going to frame things for you. Best advice, I can give, or I can think of, is probably just ignore the noise and focus on your financial plan. Talk to your financial planner, put that on your list for the year. Investment portfolios are just one part of a solid financial plan, and Ross can speak to this much more than I can. But client goals are individual, and so should their financial plan. Should be customizable to them. And the news is not customizable to us as individuals or our portfolios. So that's all I'll say on that.
I think I often talk about focusing on your personal economy versus the world economy. You got to have really good asset allocation. You got to have really good diversification. You want to align that to your financial plan. But if you can do what Dave just talked about and drown out the noise a little bit, if you've got your house in order, you're going to be on a good trajectory. Matt, last question for you. Then we'll turn it over to little financial planning questions, because we've gotten a bunch in the chat here. This question actually comes in via the chat. We work with a lot of families that we do financial planning for, and some maybe with COVID or life events may have cash on the sides right now, above and beyond what we would recommend for an emergency fund of 3 to 6 months worth of cash for the what ifs. If you've got cash on the sidelines and you don't need it immediately for a short-term goal and want to use that for the long term, what might you suggest somebody do with cash holdings right now?
Yeah, a couple ideas on that, Ross. I think, first of all, I think cash gets a bad rap sometimes. Like you said, it is necessary to have those reserves set aside for an emergency. Cash also gives you that optionality to take advantage of declining markets like we've seen the last few weeks. If this should extend and we get that long overdue correction we're looking for, having cash available to take advantage of lower equity prices is a good thing. So as I mentioned before, it's hard to find bargains in today's market, hard to make big calls, and we certainly wouldn't recommend aggressive moves. But should you get weakness in equity markets, then we would say that cash can be used to dollar cost average your way in. So if you had X amount devoted to a longer term equity strategy, you could take a percentage of that and invest it, and then do it again and average your way in until you were fully invested. So that's one thing you can do. Obviously, when we talk about portfolios, we're very focused on mutual funds, equities, fixed income, but certainly for high net worth families, there are other options out there. There's real estate, there's tangible assets, there's other things that are non-cash alternatives, if you will, to always consider in terms of a broadly diversified portfolio. And then finally, again, based on where we are right now in the inflation picture, the interest rate picture, we know cash is yielding zero. We know that inflation, no matter what number you put on that, is ever present, right? So the analogy would be cash is kind of like the proverbial melting ice cube, in that even if you're just holding cash in a bank, you're actually losing purchasing power due to the higher inflation, whether you want to define that as 3% or the recent CPI print was 7%. If you measure inflation as they used to in the 80s, inflation today is double digits. So no matter how you slice it, holding cash that, again, is over and above that emergency fund is losing purchasing power. It doesn't mean you can't hold on to cash for a certain amount of time before you can take advantage of some bargains in the market. But that being said, you're right. Over the longer period of time, cash is not your friend in this interest rate environment. There are short-term fixed income strategies that pay some yield, certainly better than cash. Certainly, it's a good holding spot, a parking place, if you will, until better opportunities arise. But I think right now the key is really to be patient because we have had, again, the last 3 weeks aside, we have had some really phenomenal equity market performance, and the bargains just have to be waited on for them to appear. And if you have that cash available, you can take advantage.
I think those are some great ideas, Matt. Thanks for sharing that. So flip the script. Now, Matt, I think you had a couple of questions that folks had submitted on the financial planning side, if I recall.
Yeah, absolutely, Ross. So these questions have come in over the last couple of weeks, and so I'll address these to Ross from the financial planning perspective. And I think the first one, Ross, we got a few different times, but it was really speaking more to the most recent history here, especially since COVID, and how has that changed for you as a financial planner, the process you go through, the interaction with clients, what has changed or what hasn't changed in the last 2 years based on everything we've gone through?
Yeah, so a long 2 years, right? I think everybody can agree with that. From a financial planning standpoint, not a lot has changed from a philosophical standpoint in terms of what we do as certified financial planners. It's all about short and long-term goal planning. Are you diversified? Do you have an adequate emergency fund? Do you have proper insurance coverages, whether it's disability, long-term care, life, things like that, making sure you're on the right track. But what has changed and what we've seen over the last couple of years is maybe a shift in priorities and maybe some values for some people with just what's gone on in the last 2 years. For example, we work with a lot of hospitals around the country, and I think there's been a lot of pressure on our healthcare system. And I've seen a lot of people in certain fields maybe push up retirement because maybe they've just said, you know what, if my financial plan says I can retire now and maybe markets have helped me a little bit, I can retire today. Subsequently, on the flip side, hybrid work has maybe allowed some people who said, hey, I want to retire at 60, 65 to maybe say, hey, hey, you know what, working from home is not that bad. Maybe I could do that for a couple more years, and they'll push back retirement, allow a few extra years of saving, tax deferred growth, things like that. I think we're talking to a lot of clients about where they want to live, where they want to retire. Is it urban or is it more suburban? Spending patterns have changed. The first year of COVID, people weren't really able to spend that much money. Now people are. We have inflation, so we're updating inflationary numbers. Healthcare is very expensive. Basic living expenses have gotten more expensive. I think people are worried about markets, worried about inflation. So a lot of our time as financial planners is kind of spent back to Dave's point of drowning out the noise and bringing it into that personal financial planning situation for that family and trying to control what you can control. So to answer your question, not a lot has changed for us. Conversations with clients have changed a little bit though.
Okay, great. Another topic that's seems to always be prevalent and came up again in a question for this webinar was talk about the people who are already in retirement. So they're past the accumulation stage of assets. It's now time to start withdrawing funds and obviously making that income stream last. But the topic or the question in this specific case was about the traditional 4% withdrawal rate. Is it still useful? Does it need to be thought about differently? What are your thoughts on the 4% withdrawal rate?
So for those that have never heard of it, it's basically a withdrawal strategy. If you retire, what's the most a retiree wants to take out of their portfolio every year? So there's a high probability that their money doesn't run out in retirement. Now, there's been a lot of studies and math done over the years, and people smarter than myself have came up with this idea that, hey, I just did 3, it's 4% that you want to take out of your account, and you adjust that for inflation. So that's what a lot of retirees will kind of do. If they, let's just use round numbers, this is a high value, but let's say you have $1 million in your portfolio, you take 40,000 out, you supplement that with Social Security, a pension, rental income, part-time work, whatever it may be. And that's a good withdrawal strategy so your money doesn't run out. However, I think there's some headwinds, and we've talked about all these headwinds that maybe markets, maybe they don't get the rates of return that we've seen over the last few years or a decade. So should I withdraw a little bit less? And we do have those conversations with some folks, and we're talking maybe a little bit more about a 3% withdrawal rate. It all comes back to, that's just kind of a rule of thumb. Like, for example, when people say, how much should I save for retirement? The gold standard is 15% of your pay every year. Well, some people need to save less. Some people need to save more. It's the same with a withdrawal strategy. I'd encourage people to just update their financial plan, talk to their financial planner, see what your withdrawal rate really needs to be. And maybe you need to update it with inflation. Maybe you take out a little bit less this year. It all comes down to personal situation.
Right, absolutely. All right, so the last question that I was going to ask, and I thought this was a great one too, but kind of an open-ended question, wanted to hear your thoughts. What are 3 things an individual can do this year to become more financially fit?
Yep. So first 2, I think, are super simple and going to be very elementary. Establish an emergency fund, number 1. I think COVID highlighted the importance of that, especially if you were furloughed or lost your job a year or so ago. Having 3 to 6 months worth of cash is what you want to have. Anything above that, if you're closer to retirement, we oftentimes talk to people about maybe having a year's worth of expenses just in cash. But anything over that, you might want to think about what to do with it. But if you don't have an emergency fund, priority number 1, I think that's a great way to get a little bit more financially fit. Second one, erase debt. I hate debt. It's one of the biggest reasons for bankruptcy in the United States is over borrowing and not being able to pay it back. So there are some necessary debts like education, or many people can't just buy a house for cash, or many of us have mortgages and whatnot, but trying to pay that down, maybe restructuring some of your debt, and that will free up capital to then save more into IRAs, 401ks, 403bs, taxable brokerage accounts, things like that. So pay down your debt, I would say, would be the second thing. And then the third thing, every financial situation is different. Every investor's profile and portfolio is going to be different. So by going through a financial plan, you can develop and establish that kind of financial GPS to show you where you should go. Should I go left? Should I go right? What's the miles per hour that I need to go? I don't know about you guys, but if I'm trying to go anywhere, I can't go anywhere without my Google Maps or whatever you use. So that's a financial plan in a really corny way to describe it, but it's financial GPS for your family. So those are my three kind of ideas, and there's many more, but we don't want to ramble on and on. So thanks for asking those questions, Matt. We've had a few actually come in through the chat. So we're at 35 plus minutes. So I think maybe I'll ask one that I've seen a couple times. Maybe I'll start with you, Dave, on this first one. I'll ask you one of the questions in here, Dave, and then I'll go to you, Matt. And I know there's a ton in here, guys, and we could probably stay on here for hours, but I know everybody doesn't want to do that. If we don't hit your question, follow up with your financial planner here at Sentinel, and we can certainly address that. But one I've seen here a couple times, Dave, is how do you build a diversified portfolio, and what are some ways to do that?
Yeah, I think. I think we've been touching on that with most of our answers. But to summarize, the U.S. has had a great run, as Matt showed in his market stats at the beginning. We still believe that having a diversified portfolio with some in international makes sense because of the valuations. International stocks to complement the U.S. stock exposure. A lot of these movements between U.S. and international stocks have been driven also by the dollar. The dollar's maintained its relative strength to the other currencies. So will that continue? We don't know. Historically speaking, if the Fed does raise rates and rates do increase, the dollar might strengthen if let's just say the Eurozone's interest rates stay low, because people will flock to the US dollar or treasuries for that extra bump in interest rates. So, honestly, that could continue, for a while, but we still think it's necessary to keep diversified between international and US. When it comes to fixed income, fixed income is going to be a tough slog, I think, especially if rates continue to move a little bit. I think, our team doesn't feel that rates are going to go too high, just like we've seen in the past where that's been tried and it's stepped back as a policy. So, there's so many mandates and so many investment policies that have fixed income as part of it. They do provide that cushion, per se, and volatility, assuming that rates don't move that much or that fast. They should hold some of that volatility for you. But, in inflationary environments, generally speaking, bonds are going to have a tough time. They do well in deflationary environments. And stocks generally tend to do well or better in inflationary times or stagnant inflationary times than deflationary times. So, with this inflation type of landscape that we're dealing with now, having that diversification between international U.S. stocks plus some bond exposure makes sense. There is also, as Matt alluded to, we do have some exposure to gold, which has always been, a kind of inflationary hedge. It's just had a little tough time against a stronger dollar right now, but that could change. So there's so many things on the table. That's why you need to be diversified, Ross, to answer the question. But I think it also, again, comes down to your plan and how it fits into what your target rate of return over time is gonna, you're gonna need in terms of reaching your financial goals.
Yeah, is it a 3% rate of return that you need to fund your goals? A 4, a 5? That's gonna a 6 or 7 or whatever it may be. That's gonna determine what your asset allocation should be. So it all goes back to just what does your financial plan need, and then you can tailor your investment program and diversification to that. we are all such long-winded people. I'm gonna just say, there's one last question in here. So Matt, I'll steal this from you, and then we'll end the session here. But a really good one just came in. What happens if you don't qualify for long-term care insurance? How to protect and/or have funds for care? So that's a good maybe financial planning one to just kind of button this whole presentation up. But long-term care is a hot button issue for many people planning for retirement, because there's a high probability you might need some care. There's some crazy statistics out there that say maybe 70% of people might need some health care support when they're retired, and that cost can be in the six-figure range annually. So two ways to go about securing long-term care coverage: insurance planning, or if you can't qualify for it, to tag onto what Dave was talking about, you could create a siloed account in a really diversified portfolio that fits your age, your potential time horizon. You can't predict when you're going to need long-term care, but we have a couple clients who haven't been able to qualify for long-term care insurance, and then they create, an individual brokerage account or something like that, fund that type of account for X amount of years with a goal to have a certain amount of money in there for if they're 80, 85, 90 years old. And that's kind of what I would call a backup plan, or self-funding. So that was a good long-term care question that came in through the chat. I guess just to close here, Matt, Dave, really appreciate you taking some time today. If we didn't get to your question, please feel free to reach out to Sentinel and we can address that individually offline. But thank you very much, and have a great 2022, everybody. Thanks.